Hey there, my name is Andrew Michael. I'm a real estate agent here in beautiful Northeast Florida. And did you notice during the COVID real estate market, we'll call it, interest rates got to all-time lows? They were 2.3 to 2.7, give or take, thereabouts. In any case, in this video, and I'm sure you've noticed that since then, the interest rates are much higher. They're not all-time highs. I can't remember what it was. I did a video a while ago, and I kind of found what was the highest interest rate in this country's history. And I want to say it was in the early 80s. It was around like 17%, something like that. But in any case, so interest rates are much higher now than what we're used to seeing. So in this video, we are going to talk about 4 ways that you can purchase a home and hopefully have a lower interest rate. And we're going to go at it right now. Hey everybody, welcome back again. My name is Andrew Michael. I am a real estate agent here in beautiful Northeast Florida. And every day my team and I helps people just like you with making a smooth transition to Northeast Florida. So whether you're looking to move now or down the road, we would love a chance to help. You can give us a call, shoot us a text, whatever works best for you. In fact, my number is right here on the screen. And we helped all these other fine folks with their move as well. There you go. So let's talk about 4 ways that you could consider for getting a lower interest rate on your next home. So the first one to consider is an ARM, or an adjustable rate mortgage. So what is that? An ARM is a specific type of loan where for the first however many years, the rate is much lower, but then after a certain time period, it adjusts to a higher rate. So the idea being you would enjoy the lower rate for a while and then refi when the before the higher interest rate kicks in. So that's one way to get a lower interest rate. Now you have to watch that though, because what happened back when the Great Recession, people bought homes with them, and then the rate, the value of the home declined. So after that, you were not able to refi the house because you owed more on it than it was worth. So the adjustable rate mortgage is a possibility, but it's definitely one you want to be careful about. So that's number 1. Number 2, owner financing. It's true that most homeowners have a mortgage and therefore they would not be able to do owner financing, but it is a possibility. In fact, I've sold homes here recently in the St. Augustine area where owner financing was a possibility. We had it on the table. Now, we didn't end up needing to do it for various reasons, but that is something you can explore. So you can ask if you're interested in a particular home. Now, this wouldn't be new construction. This would be a resale. You can ask the listing agent, hey, if would the seller consider owner financing? And let's say maybe it's kind of like an ARM, like a 3 or 4 year, and then after with a set percentage, and then after that a balloon, where you would have to refi at that point, or if you had the cash, I guess, just come in and satisfy it. So that's another possibility. The next thing to kind of consider is finding a home with an assumable mortgage. Now, this one is really a needle in the haystack, but there are certain types of loans where you can actually assume the mortgage from the old owner. So when I purchased my home, the VA loans are one of the well-known ones. So when I purchased my home, I got it with a VA home loan. So that's say you came and you purchased my home. Now my home is worth quite a bit more than it was when we purchased it. So what would happen is, let's say you are going to assume my VA mortgage. You would, the lender would have to, number 1, the lender would have to agree to it. And then number 2, obviously you'd have to qualify and whatnot. But okay, so you go ahead and you assume that portion of the mortgage that I still owe, but whatever equity I have in the home beyond that, you would either have to get a second mortgage or bring cash, both of which I guess is possible. But then the thing with the VA loans assumable is that, say for instance, you are not a veteran and you wanted to assume my VA loan, you can do that. But the problem is that my VA benefit is still tied up in the home. So I wouldn't be able to go buy another house with a VA loan if you still owned my home and hadn't refied it yet. So there's a downside to it. Also, if you went into short sale or foreclosure, then it would hurt my VA eligibility, even though at that point I don't even own a home anymore. So the easiest way to assume a mortgage that I've seen, now if you know of any other ways, throw them in the comments down below. I'd love to hear it. But the most common that I've seen is for one veteran to buy another veteran's house. That might work because then if a veteran purchased my home and they used their own eligibility, well, then it wouldn't tie up mine. So I'd still be free to go buy another house with a VA loan. And God forbid they got foreclosed on or had to sell at a short sale, it wouldn't affect my eligibility at all. So that's another way to do it. And then last but not least, probably the most common one of those is purchasing a new construction home. Now, builders will buy up, they have called economy of scale, I guess, but they'll purchase a huge, they'll go to a lender and say, hey, look, we're going to buy millions of dollars in mortgages through you, or we'll funnel millions of dollars of our buyers through your lender, but you have to give us a lower interest rate. So that's not something the average home seller can do. But that is something the big builders can do, like the Dream Finders, the D.R. Hortons, whatever big companies we're talking about. That is something that they can do. Lennar is another one. So the way that works is they typically will only do it for their homes. Now, these are new construction, but these are typically homes that are already built or close to being built. The reason is they only have so many dollars to give away at these mortgages at the lower rates. So they want to use them on homes that are going to close sooner. So it's a little easier to keep a handle on. And those homes can, they also want to incentivize those ones because they want to get them off their books. So that's another way you can do it. Another way, now I know I've already done 4, but I've got a 5th, a bonus for you. The 5th, and probably the easiest way to do it, is just to ask the seller to contribute for buying down the interest rate. So I've seen 3-1 buy downs. I've seen all kinds of ones. So the way that basically works is that the seller is prepaying the interest for either the first year and then the second year, or whatever it is, however it is they structure it. So in that case, the seller is saying, okay, Mr. Buyer, Mr. or Mrs. Buyer, I guess, or Mrs. Buyer or whatnot, we're going to prepay your interest for the first year, and in the second year, and again, I've seen up to 3 years. I guess you could do longer if you wanted to. But they're going to go ahead and prepay it, so your payment's less. And then at the end of however long that term is, once it's over and done with, well, then at that point, then the interest rate would be back up. But hopefully by then you could refi the mortgage, and then it wouldn't be an issue anyway. So there you go. Those are the top ways that I have seen to purchase a home and have a lower interest rate than the current market rates. I hope you found this helpful. Do me a favor, if you got any value at all out of this video, then give me a thumbs up. It helps me come up in ratings, and I greatly appreciate it. Also, if you're looking to make a smooth transition to Northeast Florida, you can give me a call, shoot me a text, whatever works best for you. And yeah, it'll be me that you're dealing with, and I would love to chat with you. Thanks a lot. Have a great day, and I look forward to meeting you in person. Bye-bye.